Holly.
3, 2, 1.
I'm live here today with Daniel Walsh from Your Property, Your Wealth, previous Geared for Growth guest. And I want to try and lean on you on air to do a webinar with us up around tax time too. I find it's hard for people to say no when I ask them live.
Ask them live. I'll definitely be in for that then.
I've
Put
been
me in, so.
Thank you very much for coming on board and in advance for joining me for a few Shirazes tonight. I wanted to ask you about a story that it was an Instagram piece that you did talking about lazy equity. So the idea that people kind of can own a principal place of residence or perhaps even a portfolio, but they don't realize that there's capacity in there to do something. And you did a great video where it kind of talked about a case study where it was, say, a $800,000 val and there's a $400,000 loan on it and what's possible. Would you mind recapping a bit of that for us?
Yeah, definitely. I mean, I feel like in the last, 3 to 5 years, a lot of people have equity in their property. A lot of people have what we call lazy equity. So they haven't done anything with the equity. And the equity for me, it's like, how can I best utilize that equity to make more money than it's currently doing, which is saving you the interest.
Yeah.
So when you have equity in your property, the way I like to think about it is, if you do not use the equity, you're only saving the interest on that. So in terms of if I draw the equity out, it's going to cost me the interest that I draw it out on. So if I take, let's say, a property for $800,000, got a $400,000 loan, and I'm going to take $200,000 out.
Yeah.
How do I deploy the $200,000? So if I go buy 2 properties with the $200,000, the interest rate is what it costs me. So let's say I pull the $100,000 out in equity. It costs me about $3,000, maybe 3.5%, depending on the interest rate, 3.5%. And then you go deploy that to go buy a property. So if you buy a property, the probability then is, are we buying a property with that $100,000 that's going to be growing in value more than the $3,500 essentially? Now, when we buy the new property, we want to work out the cash flow. So you work the cash flow off 100% borrowing. Plus stamp duty and legals, right? So if it's 100% borrowing or 105% borrowing, what you do is you buy a property that's fairly neutral cash flow.
Yeah.
So let's say the property's costing you maybe $500 a year, $1,000 a year, and/or it's making you $1,000 a year. Fairly neutral cash flow each way. Then what you do is you say, okay, I've taken the $100,000 out of my own home. I've gone and bought this property over here. It's costing me, let's say, worst case scenario, $1,000. Now, will this property over here grow by more than $1,000 on average per year over the next 15, 20 years? Also, will the rents over time rise as well? So if I have the rents rising, even if I was a little bit negative to begin with, I've now got a positive cash flow property in the future. I've also got equity, and now I can leverage the investment property to go to the next investment in the one after.
So we're talking about, in that example, either pulling out $100,000 or $200,000. It's either costing you $3,000 or $6,000, depending on your interest rate, right?
Yeah.
And if interest rates were 17%, you would need to kind of factor that into
that's $17,000. That's $17,000 a year, right? So if that was the case, though, the thing is, if that was the case and we saw interest rates rise like that, we'd see a lot of people wouldn't be buying property. So from where the interest rates are now, if they went to 17%, for example, so many people would sell their properties that would be very few, that the rents would have to rise dramatically to reflect that. So we would see that over time through no one buying investment properties, probably a lot of people wanting to sell up their investment properties because they don't really understand the end game.
Yeah.
And then what happens is the rents rise to reflect it. So if you have your debt down here and the rents are rising over time and the interest rates rise up and then they drop back down, then all of a sudden you're now creating the cash flow from that property. So interest rates rising can actually sometimes have a positive effect for rents rising over time.
Mm-hmm.
And then if they drop back down again, all of a sudden your cost of money is dropped, but your rents have risen because there was a temporary period where the rates rose.
Yeah.
So that can sometimes actually be good for engaging like a rent cycle.
Yes.
So the reason being is if interest rates are 3% today, they went to 5% and less people bought investments, we're going to have less rental stock. So therefore, we're going to have more pressure on prices. So that's going to reflect in your cash flows.
We're seeing that now, right, with the tightest vacancy rates in rentals that I've ever seen in my life, and I'm getting on a bit too, you know.
Yeah, well, I mean, for example, like in the last year, I would say a lot of our properties that we've purchased have gone up about $100 a week.
Yeah,
So, you know, if you rent let's say a property was 450, it's now 550.
Yeah.
And that's in 1 year. So interest rates go up a little bit, but it's not reflecting the cost of what it's costing you, depending on what the actual rents are rising. So the rents are rising dramatically, and that's just because there's such a housing shortage for rentals.
Yeah.
And even when the rates rise that little bit, it's not really hurting people that much because the rents have reflected it.
I like the fact that you're factoring that in, like, because people will just say you buy a property, it goes up, you pull the equity, you go again. But there is that sort of consideration that equity costs you money, right? You don't just get it free. You actually borrow more on the property that you're leveraging against.
I feel like, and I see a lot of rookie investors do this, right? They borrow equity against their own home, and then they go buy an investment property, and then they have a smaller loan, so a smaller debt on their own on the investment property.
Yeah.
And they factor the cash flow on like an 80 or 90% lend.
Yeah.
But they never factor in the equity that they took.
Yeah.
The equity that they take is also a cost, right? So we've got to figure out, okay, if you're going to take equity, you're borrowing 100% of the purchase price.
Yeah.
Then you're going to factor in that you're borrowing for your stamp duties, which is fine. I mean, at the end of the day, even if you had a property that you bought for $700,000-800,000 and the property costs you $2,000 or $3,000, you only have to beat long term $2,000 or $3,000 in capital growth. And then it's like, what's the probability that you're going to beat that over long term? I mean, you probably beat it just by buying well. So for me, like, we've bought properties where it's cost $1,000 to hold because it's 105% leveraged.
Yeah.
But that's pretty cheap to have a $700,000, $800,000 asset costing $1,000 per year, which is next to nothing for someone. They won't even see it.
Yeah.
And then we go buy the property, and then it goes up $100,000 in the first year. It's like, okay, well, it's cost you $1,000, but you made $100,000 or $50,000 in the first year. You're now safe for pretty much the rest of your life, because now over time that property is going to become positive cash flow because the rents are going to rise. So you went from maybe a negative scenario for maybe 1, 2, 3 years to then a positive scenario. Then you've got the equity that you can continue to leverage.
Yeah, I mean, if you break it down to the fact that if you're taking out $200,000 and let's say there's 3.5% interest rates, like, can you beat $7,000 in a year with an investment property? And that's just the first period, right? Not the compounding growth and those sorts of issues. So in this market, I think you can.
I think the biggest thing is when you're buying, when you're building a property portfolio, you're buying, you always got to look at, okay, if I have $100,000 and I put the $100,000 into my home loan, I am saving the interest rate. Can I beat the interest rate?
Yeah. Like
that's all you have to do. Now, when we talk about beating the interest rate say 3-4%. But if it's 3 to 4% plus costs, it's 5%. Now you're going to get 4% rate of return. You might lose 1%. So you've lost 1%. So can you beat that 1%? But when you're taking that money out of your home loan at $100,000, you're buying something that's leveraged 5 times or 6 times, right? Yeah. So you're using $100,000 to buy a $600,000 asset.
Yeah.
So now your rate of return on the cash that you pulled out isn't 5 or 6% because that's what the property went up.
Exactly.
It's like 50%.
Yeah.
And that's where, like, for me, like when I built my portfolio, people are like, how did you build so quickly? I'm like, because if I look at my rate of returns, yes, my properties went up 50% or 10%, whatever they went, but my cash on cash return, when I had lazy equity and I drew it out, I didn't save my 3% anymore, but I actually went and got a 50% return on the money that I took out by buying the property. Yeah. And then over time, the property went from, say, a neutral property portfolio to then a positive portfolio. So now I've got cash flow and equity for the rest of my life that I can keep leveraging.
Yeah, that's awesome. I hadn't really sort of heard anyone explain it to that level of detail, which is why I wanted to share it with the audience. And if there is anyone on there live and you've got a question for Daniel, let us know. We've got Soph behind the machine who's going to help us out. Now, I wanted to ask you something that I'm hearing as a question a lot from investors, and that is the implications for the Olympics. Right, so 2032, it's a bloody long way away, right?
It's just a little bit.
And you think about Brisbane, right? They're going to have to build some stuff, right? They've got stadiums and bits and pieces, but they're going to have to build some kit. So the question remains, what is that likely to do? There's going to be construction jobs, but there's already quite a bit going on in Queensland.
There's already a lot of infrastructure projects. Yeah, I mean, for me, the way I've sort of described it, because I get this a lot, this question, for me, I mean, I buy in Brisbane quite a bit, and people say, oh, I want to buy now because of the Olympics. And I'm like, you shouldn't be buying because of the reason of the Olympics. The Olympics isn't enough of a driver to double house prices, right? Yeah. It has some impact, yes. But I feel like psychologically the impact is bigger than the actual impact of what it has. So what that means is it's, people talking about it, it almost becomes a self-fulfilling prophecy, right? So if you're, for me, I know that I speak to a lot of clients every day and they're like, oh, I want to buy in Brisbane because of the Olympics. Yeah. They've got no data on why. They just literally are looking at it's going to be a good thing. So if we see people all over the country thinking about the Olympics as we get closer to those Olympics, people think, I got to buy or I'll miss the boat because the property market will go up. Now you're at a dinner party or something like that, and you're talking to other people. You're like, oh, we've got to buy there. The Olympics all of a sudden becomes a conversation piece. So I think that it's more so going to be that yes, it will drive it economically, but it's not going to be. That's not going to be the impact of the price-driven growth. But it's more so going to be off the confidence that people have within the market that will be what it grows by. We already saw the property market in Brisbane doing very well before it was even announced. Yes. And it was starting to take off. Now, the reason it was starting to take off wasn't because the Olympics was announced. It's because the interest rates have more than halved, but the house prices have not doubled to reflect it. Yeah. So if we look at, say, Sydney and Melbourne, when we saw interest rates at like 7% plus in 2010, we saw the interest rates go from 7.25% all the way down to where they are now. Yeah. So they've more than halved. What happens is if you halve the amount in terms of what it costs monthly, you can double the rate of what you can spend in terms of in the market. So it allowed people to go out there and get larger debts because their cost of money was a lot cheaper, more than halved. Same thing, right? So when we look at it, we saw Sydney and Melbourne double, but we hadn't seen Brisbane do that. Now, what we're also seeing, and this is where I actually think the biggest part of the growth is coming from for Brisbane, is we're seeing that if interest rates push up a little bit, it's actually going to put more pressure on the Sydney and the Melbourne market for people living there to push out of those markets. Yeah. And we're going to see them go into places that are more affordable. Yeah. Now, if you can get a job in Brisbane, and the Olympics does help with that, but it's not the sole provider, but like, for tradesmen and stuff like that, we're going to have more jobs there. So people say, okay, well, do I need to live in Sydney and have a $1.5 million loan? Or can I go to Brisbane and have a $500,000 loan? And can I still get a job and have a better lifestyle? So we're seeing people push out of Sydney and Melbourne into that region. The biggest thing though I see though is people are pushing out of Sydney and Melbourne as well with a lot of equity. Yeah. So they're selling up and they're buying cash in Brisbane. Yeah. So I've been coming up against it in Brisbane market where people have come from Sydney and got to put a $800,000-$900,000 cash offer in. Yeah. Because they've come out with $1 million.
It's like retiring in Bali, isn't it?
Exactly.
You go there and you're just like the king of your little strip.
I wish I could retire in Bali. So won't let me.
Oh, really? Well, that's another show.
Yeah.
That's
another topic.
My Dr. Phil episode. So I mean, if I can read between the lines in all of that, short-term sugar hit, like it'll be a positive thing, right? Yeah. But it's not a fundamental driver for the next 30 years, right?
Definitely not. Like it's sort of something that is more driven off hype. It does have some, economic impacts from jobs. And yes, people will move there temporarily thinking that they're going to move there for a job. Yeah. And then they end up staying, right? Because they live there for 2 or 3 years. But majority of the jobs are not created from the Olympics. We're seeing so many other infrastructure projects. But I think the biggest driver for people going to places like Brisbane is it's the third largest city. It's got the lifestyle. Interest rates are more than half, but the prices haven't doubled to reflect it. So the actual cost of living there is a lot cheaper than, say, Sydney, Melbourne. So it's people moving for lifestyle more so than going there because of the Olympics. But I do think that the investors and things like that, we'll see more people coming from investors say, I'm buying there because of that. That's their ration. If they're looking at it from a rationale point of view, they're going, okay, why am I buying there? Especially if they don't know what they're doing. I'm buying there because of the Olympics, right? Yeah. It must grow the Olympics. Yeah.
But the market psychological safety, right? Like 100%. I feel more comfortable because there's a lot of stuff going on there, and that's got to do something.
Yes, and that's what people do. They just go in and go, if I see a heap of things happening within that market, infrastructure or something like that, they'll go, heaps of infrastructure coming in, I'm going to go buy in that market,
I think you're spot on with the the remarks you make about interest rates halving and the property not doubling, like if we look at our data, we've got about 34% of all of our investor transactions at the moment going into Queensland, about 22% New South Wales, and 11% Victoria. I think part of that is, the lockdown, the weather. Queensland did a lot better in the pandemic, of course, but the median house price in Sydney is 1.6 or thereabout. I only looked at December's CoreLogic data, so maybe I'm a little tiny bit behind.
Yeah.
Canberra's about $1 million, but Brisbane's like still high sevens. I mean, if you own a house at the median price, you're making 20 grand a month, right? But there's still a huge price differential.
Exactly. So generally when cycles happen, people think the cycle's going to go on forever, right? So they see Sydney and they're like, Sydney's always going to grow.
Yeah.
Well, Sydney's not always going to grow because we've seen it in history that it doesn't always grow. 2000 to 2004, Sydney had a boom. And 2004 to 2012, it did nothing. And 2012 to 21, it doubled again, obviously with a slight hiccup in 2018. But what happened was we saw cyclical in terms of it went up, it went sideways for a while, and then went up again. And that happens because you're pushing a price too high that the wages can't afford to no longer support the pricing in that market. Same thing that's happening now. But what we're seeing is, Sydney's doubled, more than doubled, right? So we're seeing like 1.6 million, and then we're seeing like high sevens in terms of Brisbane, in terms of median, right? So we're less than half in terms of the median house price, but we're the third largest city in terms of Brisbane. And the gap has never been so wide, right? So we've seen that gap being really wide. So if we look at the history of Brisbane, most of the markets there have sort of got a 30-year history of an average annual growth rate of about 8 to 8.25%. Yeah, we're lagging
in interest, right?
Go
back to the
first long-term
question.
interest. But when we're looking at this, we're like, okay, over the long-term 30-year history, it's 8.25%. Generally, what happens is you will always, over a long period of time, you'll always go back to what the median is. So whatever the median growth looks like, you'll end up being there. So if you see Sydney from 2000 and 2004, the average annual growth rate was up there, 7, 8, 9%. Then it flatlined off, and then the average annual growth rate from 2004 to 2012 was so low that it was below the average again. So then that means that if you're a contrarian investor, you'd be going, this is why I'm buying here, right? It's under the average for a 30-year or 20-year period, and it shouldn't be. Brisbane's under the average now. It shouldn't be.
We've got time for one more. I think we do.
I
think we do. I wanted to ask you about, this is crystal ball. This is like these are the questions that I ask that people sort of hate me for the most, where I say like, and Daniel Walsh says, you heard it here first. This is the prediction of what's going to happen. But
this is the headline at the end.
Yeah. So Ukraine, no, we're not. Who knows what's going to happen there? And
no comment on that one.
Yeah, gosh, what a terrible situation. We're not doing that. We're not doing Ukraine. We're doing interest rates. So they are going to go up at some point, right? And maybe the Ukrainian conflict is going to see inflation happen. I mean, already fuel's bloody expensive. So, all the commentators are saying, maybe it's the end of this year, maybe it's next year, but it will be soon. The banks seem to be revising their forecasts. They sort of forget that we remember that when the pandemic happened, that they said it would drop 30%. We still remember that you said that, banks. But
30% drop.
Now you want us to listen to you about your predictions for these huge drops on interest rate rises. But my view is that the serviceability has always been at 5-6%. It's dropped a little bit.
Normal rates.
There's also there's also a lot of money in offset accounts, right? And then there's the ratcheting of the lifestyle, and you talk about this as well, because you put in the hard yards, and it was a property investor living in your garage and stuff. You're very good at delaying pleasure, right? You got the Jaguar now, which is mint, right? But you paid your dues.
That's
right?
it, 10 years.
So people can adjust their lifestyle in a pinch, right? They're not going to default on their mortgage and keep their HelloFresh subscription, for example. What do you think? Are you on the same lines that it's not going to have as big of an impact as people are saying?
So my opinion on this would be that if interest rates rise, how long will they rise for, and how sustainable is it, right? So to me, the economy is not doing well, right? So the economy is not doing well. We already see places like Germany and that their GDP, their forecast is a lot lower than they thought. We're already seeing this around the world where economically we are not strong, but we're taking on record levels of debt, and we continue to take on record levels of debt. So if we continue to take on record levels of debt and we put interest rates up and we force everyone to start saving more money, and what happens is we get less taxes. We get less taxes, it's self-fulfilling, it keeps going, right?
Yeah.
What do? Print more money to keep getting ourselves out of the situation we're in. So we stall the economy at the stage.
Yeah.
So I do believe that they're going to pretend to try and fight the inflation. Now, one thing that people really don't understand is that they look at interest rates and the cost of their money, which is one thing, but they never look at the inflation because it's kind of like invisible, right? But essentially, if you want to work out whether you're doing better or worse in the market, if you look at inflation, let's say inflation's 10 or 15%, but you're getting interest rates at 5%, you're in front, right? Because the inflation's devaluing the dollar more than the cost of the money, right? When it's the other way around and you're paying 5% interest rate, but your inflation's 2%, great, go into cash, right? But when it's the other way around and your dollar is getting devalued by 10, 15, because they're recording a lot lower than they should be because house prices went up a lot more than that. So what we've seen in the last year was inflation, in my opinion, at like 10 to 15% running in terms of house prices and the way that it's grown. Now, in terms of what's going to happen in the future, I think that if interest rates rise, they can't rise too much before they work out that the economy is not strong enough. So they've got two things they've got to do. Do we fight inflation? And if we fight inflation, we're going to do that at the detriment of the economy, right? Or do we save the economy? And I think that's going to be the divide in the future is, okay, what one are we going to save? I think they can't really fight inflation, right? So, and I do think that we actually, to me, we're in a period of time now where we have inflation, but we're having inflation from a lot of shortages, right? So we're seeing like oil and all of that. It's in terms of being able to get the goods and services, being able to get them over here, right? So we're seeing that over the short term. But if once that starts to filter on through and that doesn't happen long term, we're actually more in a deflationary period at the moment because our economy is not doing real well, yet we're doing better from a technological point of view. So all of our technology is getting better, which means that a lot of stuff is actually deflationary. So that's why I talk about, people losing jobs and all of that sort of style. So interest rates can't rise long term. Can they rise short term? Definitely. 2010, they rose four times. Right. But if you look at the long-term trajectory over the last, 10 years, 20 years, trajectory is always down. There's periods of up, but it's always down. It's because we're taking on record levels of debt. We cannot pay them back. We do not have the wage rises to be able to support higher interest rates. So we need to keep interest rates low over the long term. The more debt we take on, the lower the rates will be. If interest rates rise, and they will rise probably 1, 2, 3 times before this all unravels. That will probably stall more markets like Sydney because they're more interest rate sensitive. It'll push more markets up like Brisbane because people will move to Brisbane. So money still flows. It's just where does it flow? It's going to flow into different markets. You are right in the way that the last 2 years, more people have saved more money than ever. And that's because they haven't been going on holidays because they couldn't. They couldn't go on the overseas. They've cancelled the European trip for 50,000. So they've been saving more money. So when we save more money, we've now actually, a lot of them are in front of their mortgages. And the same thing that saying, the blood will be on the streets. In the last year, some northern beaches went up 54%. Tell me who's blood on the streets. I mean, 54% equity they've got in their home. If they sold it, they're going to sell their house with a shitload of money, right? So in my opinion, what we see is we see interest rates rise. We see people tighten their belts. People can tighten their belts. They've got their buffers in place, a lot of people. But what's going to happen is going to hurt a lot of new people trying to get into the market. That's what will hurt the most.
Remains to be seen. I'm glad I'm not one of the policymakers at the RBA. We'll leave it up to them. But I think, it's an interesting point. Like the money's going to be flowing to some of those more high yielding assets, right? Like because a 2% yield is not going to be. It doesn't cover things at the moment, let alone if interest rates rises. So.
Yeah, for sure. It's going to go to some of maybe the higher yielding areas, but it's going to go to more affordable areas because first home buyers, they can't afford, maybe they might not be able to afford the higher interest rates. So they're going to push out of Sydney market. So we'll see more people push out of Sydney market. That could flatten off the Sydney market essentially, right? So Sydney market can sort of flatten, which I think is actually healthy for the market. I don't think that you should be, we should see Sydney continue to rise at the rate that it has been, because that's something that you don't want to get into like a massive bubble. So I think that if we see that market flatten for a few years, it's probably good for it. Take a bit of a breather. And other markets, we're going to see not, where we saw Sydney and Melbourne be quite dominant in the last decade, we're probably going to see other markets like Brisbane, maybe even Perth, Adelaide, those markets be more dominant in the next decade.
Yeah.
That's just because we're getting labour onto the cycle.
Yeah. Awesome advice and insights as always. Thank you for joining me on whatever this show is.
Thanks,
and we'll hopefully see you.
We'll be back next week.
Yeah, we'll be back next week. Thank you very much.
Yeah, thank you.
Cheers.
Thanks for having me.
Good.
Do you have any people on it?
Yeah,
We're
they're
still live a bit.